Angeline Ong, and welcome to IG's look ahead to the 7th of December. Now, we start in Australia with trade balance figures expected there. Surplus is seen to widen to $7.5 billion in October. We are also anticipating trade numbers from China as well. Also, another surplus forecast, this time widening to $58.1 billion in November. From the UK, watch out for the Halifax house price index. This is going to be an interesting space for house builders, of course, because the UK housing market has been in the doldrums in 2023. With high mortgage rates and also weak demand. It'll be interesting to see whether there's going to be continued weakness in the house price index from Halifax. From the Eurozone, we've got third quarter GDP growth rate expected there. This is, of course, the final estimate. With the Eurozone, it's all to do with interest rates. It's now the Fed head-to-head with the ECB. The Fed expected to move first on rate cuts, but like everyone knows, there's all to play for in the game of interest rates here. Speaking of the Fed, we've got more jobs numbers out of the US, this time initial jobless claims and wholesale inventories data as well. And a few more earnings of note from the UK. Look out for Fraser's Group first half, Balfour BT, and also DS Smith out with first half numbers. From the US, it's Broadcom, fourth quarter numbers, and Dollar General. Let's cross over to Chris Versace from Tematica now, who joins us from Washington. I guess the big set piece that everyone's been waiting for this week is that Friday jobs number. Now, we had that ADP number and US indices weakened slightly, but not much has to be said. What do you make of the numbers so far, and how is this going to pan out on Friday?
Well, the ADP employment reports for November came in weaker than expected, which was a little bit of a head scratcher because most were expecting sequential improvement in the number of jobs added during the month of November, largely because of the settlement of the UAW strikes, people getting back to work. So this weaker than expected print in the ADP report raises a lot of questions about the underlying strength of the economy. And what we've started to see is expectations for rate cuts by the Fed start to once again pull forward. In short, Angeline, potentially bad news for the economy is good news for the market. Now, what do we see for Friday's employment report? Well, currently it continues to show a net gain in jobs month over month, about 180,000 up from 150,000 in October. So if we see a similar print for Friday's employment report, a weaker than expected number, we're going to see further conviction by the market that the Fed is going to cut rates not only potentially sooner than previously expected, but perhaps they may need to do more as the economy slows more than anyone was thinking.
Do you think we're going to have a sweet spot for equities sort of in a near term? But actually, if the Fed does continue to cut rates, it might be an indication that actually things are worse than initially thought, and then it might become a negative long term for equities.
It's definitely going to be a tightrope that the Fed has to walk between, does the data confirm that, yes, the Goldilocks narrative, the glide path, if you will, is emerging, or is the data falling faster than previously expected than the consensus thinks, suggesting that just that, the economy is sliding? If that happens, then I think even if the Fed continues to cut rates maybe a little more than people were thinking, the slower economic pace is going to result in renewed questions, not only about valuations, but also about revenue prospects and earnings prospects for 2024.
Thanks very much, Chris Versace, all the way in Washington for us there from Tematica. For more market-moving news, do join us on Beat the Street at 13:30 London time to give you a heads up. I'll be there, of course, to give you a heads up to the US trading day. And IG's Angela Barnes will be on at 7:30 to give you a heads up to the European trading session as well. Follow me on Twitter at Angeline Ong. This is IGTV.